So, good morning everyone. Again, this is Francis Kaliwan, and today we will have the fourth installment of our discussion for the accounting for inventories. And our topic for today's session is inventory estimation methods. Companies conduct physical inventory at the end of the accounting period to verify the accuracy of the reported inventory using the perpetual inventory recording system, or if there is no such records, to determine the amount of inventory which will be reported in the interim statement of financial position. However, there are instances wherein taking a physical inventory may be impractical or impossible for the reason that the inventories may have been damaged or lost. Hence, the companies only estimate the amount of inventory to be reported. So, estimating procedures may be used to determine the cost of inventories destroyed by catastrophe or any other reason that inventories may not be determined at the end of a given period, or to measure the cost of inventories for interim financial statement purposes and to validate the inventory cost determined through physical count. There are two alternative estimating procedures that may be used: the gross profit method and the retail inventory method. Gross profit method, also called gross margin method, is the method um, of inventory estimation that estimates the cost of ending inventory using the assumed relationship between the gross profit and sales, or the gross profit and cost of sales. So we are using here the relationship between sales or cost of sales and gross profit. That's why we are using gross profit rate. However, this method is not allowed for annual financial statement purposes, only for interim um, financial statements. Whereas the second one, the retail inventory method, this method is often used in retail industry, and this method estimates the cost of ending inventory by applying the cost to retail ratio to the ending inventory at retail price. So it's between the cost and the retail price or the selling price. This method requires entities to maintain records of both the cost and the retail or the selling price of purchases. So let us discuss first the gross profit method. So the gross profit method of estimating the cost of ending inventory is based on the assumed relationship between the gross profit and sales, or the gross profit and cost of sales. So the gross profit method actually depends on the accuracy of the gross profit rate or the gross profit percentage. So to calculate the cost of ending inventory using the gross profit method, we'll start with the total cost of goods available for sale, and that amount we all know is the summation of the cost of beginning inventory and the cost of net purchases. So from the total cost of goods available for sale, we deduct the cost of goods sold or the cost of sale, which is based on our gross profit rate. And our gross profit rate is based on the sales or net sales and cost of sales. When we say based on sales or net sales, the cost of sales is equal to net sales times 100% minus gross profit rate. So it means here that the sales account or our sales is at 100%. And when we say 100% minus gross profit rate, actually that is our cost of sales rate. So it's 100% minus gross profit rate because our um, cost of sales is just a percentage of our sales, or sales less gross profit rate, because the gross profit rate is actually given. So to determine the cost of sales, it's sales minus gross profit rate. And that rate is multiplied with the sales or net sales for us to get our cost of sales. And when we say based on cost or based on cost of sales, The cost of sales is equal to net sales divided by 100% plus gross profit rate. So unlike based on sales, this time the cost of sales is the ones with 100%. So our sales now is 100% plus the gross profit rate. Okay, so again, to determine the cost of sales based on cost of sales, net sales divided by 1 or 100% plus the gross profit rate. For purposes of determining the cost of goods available for sale, the net cost of purchases is computed in usual manner. That is, to consider freight in and the deductions or the contra purchases accounts, which are the purchase returns, the purchase discounts, and allowances. However, for purposes of computing cost of goods sold or cost of sales, using the gross profit method, net sales is computed by deducting sales returns only. Um, Sales discounts and sales allowances are normally disregarded in computing the net sales because they do not involve physical flow of merchandise back to the company. So again, if it is based on sales, our cost of sales is equal to net sales times cost of sales rate or 100% minus gross profit rate. And if it is based on cost, our cost of sales is equal to net sales divided by 100% plus gross profit rate. And then, for purposes of determining the cost of goods available for sale, net purchases is computed in usual manner. Add freight in, less, or deduct the purchase returns, discounts, and allowances. And for purposes of determining the cost of goods sold or cost of sales, net sales is reduced by the sales returns only. So sales allowances and sales discounts are disregarded. So to illustrate the gross profit method of estimating the cost of ending inventory, let us have some illustrations. So illustration number one is about DAC Company. So DSC Company's records revealed the following. Beginning inventory is 450,000, purchases is 3,150,000, and sales of 4,200,000. The physical inventory conducted at year-end revealed that 500,000 was in the company's warehouse. However, the company's president suspects that some employees may have pilfered some inventories. So the requirement is to determine the cost of missing inventory if there is any. If gross profit rate is 40% of sales, that's number one, or 40% of cost of sales, that's number two. So to answer this problem, let us have these solutions. So first, gross profit rate is 40% of sales. Since gross profit is 40% of sales, we can compute that the cost of sales ratio is 60% of sales. No? So it's 100% minus 40%. So our cost of sales ratio is 60%. So again, we will start with our total cost of goods available for sale. That is 450,000 plus 3,150,000. That is a total of 3,600,000. And from that, we deduct our estimated cost of sales. So again, 60% of sales. So 4.2 million times 60%, that is 2,520,000. And 3,600,000 less 2,520,000. Therefore, our estimated cost of ending inventory is 1,080,000. So that should be the cost of ending inventory. But based on the physical inventory conducted at year-end, only 500,000 was found. So we deduct the 500,000 inventory in the warehouse from the should be cost of ending inventory or the estimated cost of ending inventory of 1,080,000, and therefore the estimated cost of missing inventory is 580,000. So if the gross profit is 40% of sales, our answer for the estimated cost of missing inventory is 580,000. Next, gross profit is 40% of cost of sales or 40% of cost. So, to determine the estimated cost of sales, our solution for that is sales divided by 1 plus 40% or 140%. So again, we'll start with our cost of goods available for sale of 3,600,000. And then we deduct our estimated cost of sales, which is 4.2 million divided by 140% or 3 million. And therefore, our estimated cost of ending inventory is 600,000. And again, we deduct the um, physical inventory at year end, which is 500,000. So the estimated cost of missing inventory using the gross profit based on cost of sales is only 100,000. So again, our answer for letter A, gross profit based on sales, it's 580,000. Whereas our answer for letter B, gross profit based on cost of sales, is 100,000. Now let us have illustration number 2. On May 6, 2020, a flash flood caused damage to the merchandise stored in the warehouse of Manuel Company. You were asked to submit an estimate of the merchandise destroyed in the warehouse. The following data were established in 2019. Net sales were 8 million, matched against cost of 5.6 million. So 2019 data were also given. Merchandise inventory on January 1, 2020 was 2 million, 90% of which was in the warehouse and the remaining 10% was in the downtown showroom. So beginning inventory, 90% in the warehouse, 10% in the showroom. From January 1 to the date of flood, which is May 6, you ascertain that the following: invoice value of purchases all stored in the warehouse is 1 million. There is also freight in of 40,000. There is purchase return of 60,000. And then the cost of merchandise transferred from the warehouse to the showroom was 80,000. So as of the date of flood, there are a total of um, 200,000. That's 10% of the beginning inventory of 2 million plus 80,000. 280,000 cost of merchandise in the showroom. And then net sales from January 1 to May 6, all from the warehouse, was 3.2 million. So assuming a gross profit rate in 2020 to be the same as in 2019, what was the estimated cost of merchandise destroyed by the flood? So in this problem, we have to determine the gross profit rate in the previous year, which is in 2019, because that gross profit rate will also be used in 2020. So the gross profit rate from 2019 to 2020 did not change. So to answer this problem, let us have this solution. So first, we'll start with our beginning inventory. It's 2 million, and then we add our net purchases. Our net purchases is, so the value of purchases is 1 million, and then we have freight in of 40,000, and then we have purchase return of 60,000. So our net purchases is 980,000. So 980,000 plus beginning inventory of 2 million. So our total cost of goods available for sale is 2,980,000. Then we deduct our estimated cost of goods sold. How do we determine our estimated cost of goods sold? According to the problem, the gross profit in 2020 or gross profit rate in 2020 is the same in 2019. So let us determine our gross profit rate in 2019. The following data were established. So 2019 net sales is 8 million and cost is 5.6 million. So 5.6 divided by 8, that's 70%. Therefore, our gross profit rate in 2020 is also 70%. So we multiply 70% with our net sales. So net sales from January 1 to May 6 is 3.2 million. So 3.2 million times 70%, that's 2.24. So 2,240,000, that's the estimated cost of goods sold. We deduct that from our total cost of goods available for sale. So our estimated cost of ending inventory is 740,000. And then we also deduct from the estimated cost of ending inventory the undamaged inventory. So, what is the cost of undamaged inventory? First is the inventory in the downtown showroom. Beginning inventory of 10% times 2 million, that is 200,000. And the merchandise transferred from the warehouse to the showroom of 80,000. So a total of 280,000 undamaged inventory. So 740,000 estimated cost of ending inventory less the cost of undamaged inventory, which is 280,000. So our estimated cost of damaged inventory is only 460,000. So now that we're through with the gross profit method, let us discuss the second inventory estimation method, which is the retail inventory method. So once again, the retail inventory method is often used in the retail industry for measuring inventories of large numbers of rapidly changing items with similar margins. So that is our first requirement. Similar margins for the different types of inventories for which it is impracticable to use other costing methods. So typically, retail inventory method is used by grocery stores, sari-sari stores, or department stores, or those companies with large quantities of inventories. So the problem of those companies is it would be extremely difficult to determine the cost of each sale. Therefore, an alternative is to compile inventories at retail prices. That's why the retail inventory method requires the maintenance of records of purchases at both cost and retail price or selling price. So as you can notice in the given table, um, we have two columns, no? The cost and retail. So for beginning inventory and net purchases, and ultimately for goods available for sale, we have the cost column and the retail column. The cost and the retail amounts are very much important in the retail inventory method because these two amounts will be used in the determination of our cost to retail ratio. This cost to retail ratio is applied to our ending inventory at retail for us to get or to determine the cost of our ending inventory. So again, um, we get our or we determine our cost to retail ratio, and we can do that by dividing the cost of goods available for sale and the retail or the goods available for sale at retail. And then when we get or when we are able to determine our cost to retail ratio, we apply that ratio to our ending inventory at retail, and then we can get our ending inventory at cost. Now the question is, how can we determine the ending inventory at retail? We just simply deduct our sales or net sales, including normal losses and employee discounts from gross available for sale, and yun, we can get our ending inventory at retail. So once again, um, cost and retail amounts are maintained for the purchases for us to get our cost to retail ratio. The cost to retail ratio is applied to our ending inventory at retail, which is determined by deducting the sales and other amounts from our goods available for sale. So once we are able to apply the cost to retail ratio to our ending inventory at retail, we already have our ending inventory at cost, or simply the cost of ending inventory. And then once we have our ending inventory at cost, we can already compute our cost of sales. We just deduct the cost of our ending inventory from our goods available for sale. So we can get our cost of sales. So in the retail inventory method, there are some items that require special treatments or special considerations. So in determining the goods available for sale, um, the treatments for purchase returns, discounts and allowances, and other special items are summarized in this table. So again, for the beginning inventory and for our purchases, um, they are maintained at both cost and retail. Then purchase returns are deducted for both cost and at retail, whereas purchase discounts and allowances are deducted only from purchases at cost. Freight in is added only to purchases at cost. The original selling prices of goods may be modified as a result of some market and economic forces. Thus, we have these some new items. We have net markup, which is markup less markup cancellation. And we have net markdown, which is markdown less markdown cancellation. So these two items are only considered for the goods at retail prices. Then we have abnormal loss. So abnormal losses are deducted from both cost and retail amounts of purchases before computing the cost ratio. And then we also have departmental transfer in or debit, which is an addition to both cost and retail amount of purchases. And we also have departmental transfer out or credit, which is a deduction from both cost and retail amounts of purchases. And finally, before we discuss some illustrative problems about the retail inventory method, let us have the two types of the cost to retail ratio. So we have number one, the average cost to retail ratio, which is determined by dividing the goods available for sale at cost with the goods available for sale at retail. Number two is the FIFO cost to retail ratio. So FIFO cost to retail ratio is goods available for sale at cost excluding beginning inventory over goods available for sale at retail also excluding the beginning inventory. Why are we excluding the beginning inventory? Because as we all know, beginning inventories are the ending inventories of the previous accounting period or periods. And since they come from the previous periods, they already have their own um, ratio. So beginning inventories have their own cost to retail ratio in the previous period. So in computing the cost to retail ratio using FIFO in the current period, we exclude the beginning inventories. So now let us have the first illustrative problem about the retail inventory method. So Chic Department Store uses the retail inventory method. At the end of June 2020, the records of the store provided the following. So beginning inventory at cost is 355,000, whereas the beginning inventory at retail is 750,000. Net purchases at cost and retail are 2,400,000 and 4,000,000 respectively, whereas the sales, which is of course at retail price only or at the selling price only, is 3,500,000. So the requirement is to determine the cost of goods sold and ending inventory under the FIFO cost basis and average cost basis. So we'll answer the problem using the FIFO cost basis first. So the FIFO cost to retail ratio. So we'll start with our beginning inventory at cost and at retail. So 355,000 and 750,000 respectively. And then we add our purchases both at cost and retail as well. So purchases at cost is 2,400,000 and purchases at retail is 4,000,000. So our goods available for sale at cost is 2,755,000, whereas our goods available for sale at retail is 4,750,000. And then we deduct our sales for the period, which is 3,500,000, for us to get our ending inventory at retail, which is 1,250,000. And that amount will be multiplied with our cost to retail ratio. Our cost to retail ratio using the FIFO method is we just divide our purchases at cost over our purchases at retail. Again, we do not include our beginning inventories of 355,000 and 750,000 because this inventory has its own um, ratio, okay, coming from the previous period where it came from. So for our current cost ratio using the FIFO method, it's 2,400,000 divided by 4 million or 60%. So 1,250,000 our ending inventory at retail times 60%. So our cost of ending inventory is 750,000. And then to determine our cost of sales or cost of goods sold, we just deduct um, from the goods available for sale at cost of 2,755,000, the cost of ending inventory of 750,000, and therefore we get our cost of sales of 2,005,000. So again, cost of ending inventory is determined by multiplying the cost to retail ratio with the ending inventory at retail. And then cost of sales is determined by deducting the cost of ending inventory from the goods available for sale at cost. How about using the average cost basis or the average cost to retail ratio? So, of course, we will also begin with our beginning inventory. Then we add our purchases. So we have our goods available for sale, both at cost and retail. And then we deduct our sales of 3,500,000. Our ending inventory at retail is the same, 1,250,000. So both for the FIFO cost basis and average cost basis, ending inventory at retail is the same, 1,250,000. The difference would be with the with our cost to retail ratio. So in the previous illustration using the FIFO basis, we determined the cost to retail ratio by just dividing the purchases at cost with the purchases at retail. This time, since we are using the average cost basis, we include already the beginning inventory. So we divide the goods available for sale at cost over the goods available for sale at retail. So it's 2,755 divided by 4,750. Our cost to retail ratio using the average cost um, basis or the average cost method is 58%. So ending inventory at retail of 1,250,000 times our cost to retail ratio of 58%, then our ending inventory at cost is 725,000. Next, to determine our cost of sales or cost of goods sold, we deduct 725,000 from our goods available for sale at cost, which is 2,755,000. Then our cost of sales is 2,030,000. And now let us have the second illustrative problem for the retail inventory method, the London Company. So London Company uses the retail method of inventory valuation. The following information is available. So beginning inventory at cost 145,000, beginning inventory at retail is 160,000. Net purchases at cost 283,920, whereas at retail, it's 420,800. And then we have additional markups of 25,200, markup cancellations of 9,200, markdowns of 38,100, markdown cancellations of 6,900. Then we have sales of 450,000, sales returns of 15,200, and sales discounts 3,800. Then determine the cost of goods sold and ending inventory under the FIFO and the average cost basis. So similar with the previous illustration, let us answer the problem first using the FIFO cost basis. So again, we'll start with our beginning inventory. So beginning inventory at cost is 145,000 and um, beginning inventory at retail is 160,000. Then we have net purchases. So the problem already determined the net purchases, no? But then again, if contra purchases accounts are given in the problem, only the purchase returns are deducted at cost and at retail. Purchase discounts and allowances and freight in are considered only at purchases at cost. So net purchases at cost 283,920 and net purchases at retail is 420,800. And then we have net markup. So that's additional markups of 25,200 less markup cancellations of 9,200. So net markup of 16,000 added to the retail column. And then we have also net markdown. So net markdown of 31,200. That's markdowns of 38,100 less markdown cancellations of 6,900. So net markdown of 31,200 is deducted from the retail column. So our total goods available for sale at retail is 565,600. And from that amount, we deduct our net sales. Our net sales is sales of 450,000 less sales returns of 15,200 and disregard the sales discounts of 3,800. So similar with the gross profit method, we only consider the sales returns in determining the net sales simply because sales discounts and allowances do not involve physical flow of goods back to the company. No? So our net sales is 434,800. We only considered sales returns of 15,200. So total goods available for sale at retail of 565,600 less net sales of 434,800. Therefore, our ending inventory at retail is 130,800. Then we multiply it with our cost ratio. So since this is a FIFO cost basis, we do not include the beginning inventory in determining our cost ratio. So it's 283,920 divided by 565,600 minus 160. It's 405,600. So 283,920 divided by 405,600, that's 70%. So 70% cost to retail ratio multiplied with ending inventory at retail of 130,800. So our ending inventory at cost is 91,560. And then for us to determine our cost of sales, again, we simply deduct our cost of ending inventory of 91,560 from our goods available for sale at cost, which is 428,920. So we have our cost of sales at 337,360. And finally, for the average cost basis, so again, as I've mentioned a while ago, the total goods available for sale, the net sales, and the ending inventory at retail will be the same for both the FIFO cost basis and average cost basis. The only difference will be the cost to retail ratio. So for this particular problem, our cost to retail ratio using the average cost basis is 428,920 we already include the beginning inventory. Divided by 565,600, our cost ratio is 75.83%. So we use up to two decimal places. So 75.83 percent times 130,800. Then our cost of ending inventory is 99,186. And then the cost of ending inventory of 99,186 deducted from our goods available for sale at cost, which is 428,920. Then our cost of sales is 329,734. Okay, so that's it. That is our discussion for the inventory estimation methods, gross profit method, and retail inventory method.